All right, let's dive right into this. Welcome to This Explainer, where we're going to tackle a world that is equal parts totally fascinating and honestly pretty overwhelming. We're talking about the endless quest for the perfect trading strategy. If you've spent literally any time online looking at finance content, you've definitely seen them, those jaw-dropping claims about guaranteed wealth and totally unbeatable market setups. But how are these massive claims actually tested and validated in the real world? Well, today, we're going to demystify the rigorous processes and sometimes the really harsh truths behind these claims. We're going to break down the tools, the math, and the serious psychological warfare involved in proving if a trading strategy actually works.
You know those flashy, sensational promises that just flood our feeds from the whole finfluencer ecosystem, right? Titles screaming things like, "Watch me live backtest my 70% win rate strategy, the perfect XAUSD strategy," or the incredibly bold, "Verified trader, I took $6,000 to $25 million." I mean, they offer this incredible allure of ultimate financial freedom, usually through some secret algorithmic tweak or a hidden price action trick. It's an amazing hook for sure. But as smart learners, we've got to look right past the clickbait and ask, what actual data is supporting these massive claims?
Section 1. Chasing the perfect strategy. Unpacking the claims behind the clickbait. So, content creators like PB Blake, for example, frequently highlight these massive win rates, like 70%, as the absolute hallmark of their success. And hey, a 70% win rate sounds fantastic. You win 7 out of 10 trades, you're bound to be rich, right? Well, the reality is that while literally anyone can claim a high win rate online, very, very few actually show the deep, continuous data required to back it up. Because to prove a true 70% win rate, you need a massive sample size of trades across all sorts of different market conditions. You have to prove it wasn't just a lucky streak during a raging bull market, you know? And that brings us to the foundational concept used to actually prove these strategies: backtesting. So, backtesting is simply the process of using historical market data to simulate how a specific trading idea would have performed in the past. Creators will run their rules over years of data on assets like the SPY ETF or XAUSD, which is gold, just to see if their logic holds up. But, and this is absolutely crucial, while backtesting is essential, a live strategy test in real market conditions is always better than backtesting alone. Why? Because historical data is static. Live markets are breathing, unpredictable beasts. Live testing accounts for the harsh realities that backtesting completely misses, things like execution latency, sudden slippage, and real-time spread widening.
Section 2. Tools of the trade, the software powering the tests.
So what are these traders actually using to run these tests? There are essentially two main camps of software. First up, we have TradingView. As highlighted by folks like TC Trading, this platform uses something called the Pine Editor, which lets users script strategies and test them against live data feeds like the SPY. It's super visual and really user-friendly. Then, in the other corner, we have MetaTrader 5, or MT5, which is heavily promoted by algorithmic traders like René Balke. MT5 is basically the heavy-duty engine of the trading world. It utilizes expert advisors, or EAs, and custom coding to run highly complex, fully automated strategies.
But here's the thing. Regardless of whether you are in the TradingView camp or the MT5 camp, running a realistic test requires one absolute non-negotiable element: high-quality tick data and live market feeds. You simply cannot validate a perfect strategy using low-quality, delayed, or gappy data. To simulate real market conditions accurately and actually account for those exact spread widenings and instances of slippage we just talked about, your software has to process every single micro movement or tick of the market exactly as it happened.
Section 3. The testing methodology, building a rigorous validation process.
Okay, let's break down the step-by-step methodology, mirroring the kind of systematic approach shown by traders like PB Blake. Step 1 is analyze setups. Picture this: you're watching a live Bitcoin chart right now. You don't just jump in. You set strict filtering rules. You're watching the live candles form, maybe waiting specifically for a moving average crossover to happen, while your RSI indicator is completely oversold. Then comes step 2, track results. Once that exact confirmation triggers, you enter the trade. And honestly, this is where the real work begins. You have to manage your stop loss and take profit in real time, actively battling that slippage and sudden price spikes. And you record the outcome meticulously, logging every single detail of the win and loss breakdown. Finally, step 3, validate strategy. You repeat this whole process across dozens or even hundreds of live, tracked attempts. because it's critical to see how this exact same strategy performs when Bitcoin is in a raging, high-volume bull market, versus, say, when gold is just chopping sideways in a low-liquidity consolidation phase. Only after accumulating that deep performance tracking data can you actually say whether the system works.
Now, the quiet, totally unglamorous secret of all this testing is avoiding the mistakes that skew your results. Because during live tracking, it is so incredibly easy to cheat yourself. To prevent a false sense of security, strict risk management is vital. That means maintaining a fixed risk per trade and absolutely no over-leveraging during your tests. Think about it. If you risk 1% on one test trade and then 10% on another, your data is completely useless. You literally have to treat every single trade simply as data collection, entirely removing your personal emotions from the equation.
Section 4. Overcoming trading emotions. The psychological battle of the markets.
This brings us to a massive divide in the trading world: manual versus automated trading. Manual trading is heavily susceptible to human emotions. I mean, it requires staying incredibly calm under deep uncertainty, not forcing trades just because you're bored, and peacefully accepting both wins and losses as just part of the validation process. And let's be real, that is incredibly hard for the human brain to do. Automated trading, on the other hand, utilizes bots to execute the strategy perfectly, exactly as tested, completely neutralizing all that emotional interference.
Let's look at this quote from René Bauke because it perfectly encapsulates this psychological battle. He says, "After not being profitable with manual trading, I found success by automating my trading strategies. This made me overcome emotions and helped me to execute my strategies perfectly." He literally had to remove himself from the physical act of clicking buy or sell just to stop his own emotions from ruining a mathematically sound strategy. For him, automation was the key to perfect execution.
Section 5. The harsh reality. Understanding the true risk.
So, let's ground ourselves for a second. Check out this direct quote pulled from the severe risk disclaimers that are usually buried deep in the descriptions of those flashy YouTube videos. Investors could potentially lose all or more of the original investment. Wow. It is a stark, sobering reality. And it contrasts so sharply with those "I took $6,000 to $25 million titles" we saw at the very beginning of this explainer. It's a very necessary reminder of the profound financial danger inherent in leverage and derivative markets.
Furthermore, we always have to remember the golden rule of quantitative finance. Past performance is not an indication of future results. You could have a 20-year backtest on gold that looks like a beautiful, perfectly upward sloping mountain, combined with 2 whole years of profitable live trading. But the market is constantly evolving. Macroeconomic conditions change, algorithms adapt, and liquidity shifts. A flawless historical track record simply does not guarantee a single dime of future profits.
So, we've broken down the clickbait, we've explored the software, outlined the rigorous live testing methodology across varied market conditions, and faced the heavy psychological and financial realities of the market. Now, it's your turn to engage with the data. Which trading strategy, whether it's a specific Bitcoin scalping method, a gold swing trading system, or something completely different, would you want to see put through this rigorous live testing process next? Leave your thoughts and let us know what we should demystify next time. Thanks so much for learning with us on this explainer, and we will see you on the next one.